Hey there, this is Casey with the M&A Launchpad podcast. Want to let you know about October 25th. Put it on your calendar. This is a do not miss one-day event. There's going to be incredible headliners, but really at the end of the day, you're going to get a chance to talk to people that have made acquisitions, learn from some of the challenges that they've made, because this is definitely a challenging process. But more importantly, there's going to be people there that can help you and support you along the way, from great vendors, quality of earnings, how to run the due diligence process, and how do I get financed? How do I raise capital? How do I structure all of these things? October 25th in Chicago, we're going to be gathering. It's going to be hundreds of people that are all focused, like-minded people. And man, everyone that's come has given us incredible feedback. So mark your calendar, October 25th in Chicago. We look forward to seeing you there.
All right. On today's episode, we interviewed Cory Sandrock, where we talked about what it's like to basically get out of theater, get into private equity, and really start to buy businesses and build the business focused on being an independent sponsor and identifying business. And we did a deep dive into basically buying an HVAC company that had a great successful exit, had the right person in place to go ahead and build on and grow on. And then, really start to digest really what's the mentality of a seller, what's the mentality of a buyer, and how do you get deals done, right? It's not a one person accomplishes it all. It's a team sport. And so what are the players there and how does it all work together? So Ben, what were some of your takeaways?
I think, very interesting guest today. And I think at the end of the day, he has an interesting journey. He started off in theater. He worked on Broadway. He put theater projects together. And I think he started seeing himself kind of gravitating more to the business side of it. And I think that's what led his journey to being an independent sponsor. But I think in today's episode, I think we really kind of try to unpack the differences. Like there's a searcher, there's an independent sponsor. What is the difference of that? And ultimately, trying to understand, in this climate, right, in this kind of competitive environment, like which one's best, right? And then really, I think it's dependent on what you want to do. So love some of the takeaways that he had. I mean, he's been in the trenches, but he's also been on the board and he's raised money and done creative deals. And I think you're going to kind of talk about that. Like we said, on the HVAC side, there's some creative deal structure stuff, but ultimately very, very interesting episode talking more about the independent sponsor world. And I think it's something that people need to take into consideration.
Yeah, and ultimately, Cory's just like us. He's a deal junkie, right?
Yeah.
So we talk about kind of putting those together. So
yep, love it.
This one.
Hey guys, go ahead and just pause the podcast for a second. When you're buying a business, you need to ensure the financial health of the company. The quality of earnings is mission critical. It doesn't matter what size business you're buying. Patrick O'Connell Advisory Group, they're dynamic. They do a great job. They're going to look over your shoulder. They're going to make sure that you're doing the right thing. And this guy's done over 200 buyers successfully, just like you. So reach out to him. And it's O'ConnellAdvisoryGroup.com. Click the link in our show notes. Can't live without them.
Hey, Cory, welcome to the show.
Thanks so much for having me.
No worries. Excited to see you here in a couple of weeks in Chicago. So for the listeners, you want to just share a little bit about your background and kind of what you currently do?
Sure. My name is Cory Sandrock. I'm the managing partner of Pareto & Company. We are an independent sponsor that I founded in 2016, and we like to invest in good businesses in really fragmented industries like services, B2B products, niche manufacturing, things like that. And also, fun fact, I was a theater major undergrad, so I'm actually a fun, creative guy in addition to being a numbers guy.
Ain't nothing wrong with that. I like to say whenever I used to work at Microsoft, my manager used to have a music degree, and he was a program manager. So anyone can do anything. So I guess, with that said, Cory, maybe share with the listeners, how did you get into the space, right? And what was that first acquisition?
Sure. So like I said, I was a theater guy by original training. I was mostly a producer, writer, director. Yes, I was an actor once upon a time, but as I got through college and then exited, I went to New York. I was creating productions. I was putting shows together. And the funny thing is, being a theater producer is being an independent sponsor. We don't call it that. That's not cool to say, but it's basically what it is. You're going out, you're putting together an idea, a concept, an investment thesis, and you're raising money for it. you're hiring the actors, you're adding value through operations, right? Meaning managing crazy actors. And then closing night, everybody's fired and you start all over again. And so, really my whole original career was doing what I'm doing now. I just didn't know that's what it was. And so when I went to business school, I went because I thought I wanted to keep doing theater and do it at a higher level. And then I accidentally fell in love with economics and finance and accounting. And so then the quest was, how do you sort of merge the two together? And I did a bunch of different things within the broader finance space. I was a commercial banker. I was an investment banker. I worked in private equity once before. Along the way, I kept meeting more individual investors who had this idea of doing private equity a little different. We all wanted to put money to work, but we wanted to somehow be involved, not just put our money in a fund and hope it works. And so ultimately, I founded Pareto & Company to try to do that. Now, this was 2016. It was before independent sponsor was a defined category. It was really even just the beginning of the search fund idea also. And so there was this kind of idea that maybe there's a different way to do private equity, but we don't know what it is. And so in those first couple of deals, it was, how do I do a private equity deal with no fund? And, how do I find good opportunities? And so, really our first two opportunities that we found were, I'm at a conference, I meet a CEO, the CEO is telling me about the product. It's interesting. I know an investor that I know that I've done deals with is in the space. Okay, I can have an opinion about this. Let's dig in more. Let's start talking. And it really kind of set the stage for subsequent deals that we've done because of the fact that all the actual businesses that we have acquired that we've closed on are proprietary deals. So I'm not going to auctions, to business brokers, investment bankers. They're great resources, but my experience has been, I want to go talk to the actual owner and try to get to know them and figure out, particularly not just because then you're not competing against somebody, but also because then I can explain a little bit more about us. Because for that owner that wants a really big check as fast as possible, we're never going to be the partner. That's just not how you get independent sponsor deals done, right? You got to put the pieces together, find the capital, find the people, and mix that cake into something awesome. And so if you kind of miss that phase of the get to know you, it's harder to, I think, get the deal done. And so to your question, those first couple deals, these were smaller investments in smaller companies. One we still have in our portfolio. It's a fintech company. They make software for financial advisors. And it was literally, I met the CEO at a speaking engagement, and he and I were sitting next to each other in the audience and got to talking, and it kind of escalated from there. And that was maybe a good kind of precursor of, hey, this is the way to get it done. These are the ways that someone will want to talk to you because you're not big private equity.
Got it. So a lot to unpack on that. So first of all, let's go back to the theater part, right? And Ben can speak to this. We have a friend in the theater business, and I'll let Ben kind of share how that friend talks about investing in theater.
Yeah, I think he did well. I would go ahead and say, he's one of the guys on Hamilton. I think he did Moulin Rouge. And he lives in New York, and we met him through our commercial real estate journey, but ultimately he equated, investing in theater production as like, do you like to gamble your money away in Vegas, right? Because it really is a crapshoot. And I think, and I'm sure there's probably some mechanism that you can de-risk those types of deals. But at the end of the day, it's like drilling an oil rig or trying to put a movie together, right? You're never going to know if you're going to be successful. So I would imagine there was a little bit of that journey for you too, right?
Definitely. The hardest thing when you think about articulating a return profile for a theater investor, it's really more like VC, right? In the sense that you're making, to your point, you're making a gamble on an idea that really has no comparable deal to look at, right? It's not that you can say like, oh, Hamilton is exactly like this other musical. It's not. It might have elements, right? Oh, this actor or that actor is in this other musical that was really successful. Great. They might have been awesome in that musical and horrible in this one. And so it's really not comparable in any traditional sense. And so you're right. A lot of what you're selling in the theater is the idea of being inside the tent. you're one of the cool kids. You get to come to the after party. You get to go do the red carpet. That's what's really fun and exciting. We think there's a return, and here's our pro forma, but it might be zero, right?
Yeah,
and
so I think that's what the friend said too. A lot of people, it's that feeling, and I think it's the difference between speculating and investing. Right, speculating is you're making a big bet without a lot of consistency, history, whatever you call it. Versus, I think going down, your path, right? You got into economics, started to understand investing, where it's based on core principles, repeatability, right? Some of these other mechanisms that then open up your eyes and kind of, okay, this is what investing is about, right? And I think that's, and I don't want to put words in your mouth, but I'm guessing that's what attracted you to kind of getting into where you got, right?
I think that's right. At the end of the day, the tricky thing with theater, again, and I think the corollary to venture capital is a apt one in the sense that, if you think of a classic venture capital fund who's going to invest in maybe 30 to 40 startups, their playbook is, well, we're doing 30 or 40 because we know that 35 will be zero, 4 will be okay to maybe making $1, and 1 will be $3 billion. And so the one winner will pay for all the losers. And if you're thinking of it that way, it's fine, right? Because then you are making kind of, to your point, speculative guesses. But if you do enough, the numbers bear out. And theater's the same way. I mean, the big organizations, if you think of a corollary here being the archetype of an investor being a traditional private equity or venture capital fund, those are the Broadway headliners. Those are the Schubert organization folks, the really useful group, Andrew Lloyd Webber's company, right? These are the big producers where they can do those 30 and then they can lose money on a bunch, and then they have a winner. They have a Hamilton, right? They have a Phantom of the Opera that can run for a long time and can make them all that money. And so, to your point, it's a hard pill to swallow as a creative. Somebody in my position where I might have had a great idea and a great show that I wrote or I was directing, and I'm like, this is such a cool thing, right? And I got this actor who's the next Tom Hanks, and we're gonna be awesome. And if it can't make money, it can't make money, right? Like that's just life. And so it's a little bit of understanding. For me, it was understanding the economic tools to be able to explain why. Maybe it didn't make me feel any better, but at least I could explain why my show was unsuccessful versus an actual investment.
And so I'm kind of curious. So, starting off in that space, right? Obviously, there is a financial component to it, a raising equity component to it. So there is some similarities, but how did that kind of really dive a little bit deeper into your journey from that into the private equity? And you even said that you were on the investment banking side. Those are totally different worlds. Yes, everybody's money's still green, but you're like, how did you go from that? And ultimately you said that you kind of started, seeing yourself liking that more. So what did you like more about it versus the theater space too?
So at the end of the day, I've always, I think, been a little bit of a right brain, left brain kind of person. And so, even when I was a theater major in undergrad, so I went to Northwestern here in Chicago, and it's a great theater school, right? Top 5 in the country, lots of famous people, Charlton Heston, David Schwimmer, you name it, right, has come out of that school. So I knew I was getting a great theater education. I knew I was preparing myself for that field. I also took physics. I also took linguistics. I also took, some other science and math kind of, because I always had an interest in understanding things and deconstructing. And so it was always there in the back of my head. I think, once I got to business school, so I went to the other end of town. I went to Chicago, got my MBA. That's known as a quant school, right? I went there because I specifically wanted to get the stuff I hadn't gotten in undergrad. And so I think for me, it was an aha moment of, now I have some quantitative scientific tools I can use to explain some things that were frustrating to me in the theater world. How can I deploy those tools, right? How can I kind of exercise that muscle? That's a little different than my creative muscle, but how can I use that? And so my first job out of business school was actually in wealth management. So I went to UBS, I was in wealth management. And for me, I thought that's an easy leap, because it's okay, I'm talking to rich individuals to try to get them to put money in my play. Now I'm going to talk to rich individuals to get them to give me money to invest, right? So I'm that's a pretty similar conversation, right? And frankly, actually, funny story. My biggest client that I landed in those early days, we ended up in my first meeting with him. All we talked about was Shakespeare. Like once he heard that I was a theater guy, he was a theater guy too. We sort of geeked out about Shakespeare, talked about the quarto edition versus the folio, and did things like that. And so I ended up like winning the business, having shown no prowess in investing or talking about what we were going to do with this money, but just because there was like a similar, bonding over what we liked. And so I think it was a series of things like that, where the more I did in finance, the more I was always looking for how can I be both creative and use the quantitative.
Yep.
How can I kind of merge those two? I mean, even when I worked in private equity, so I worked for a fund that was buying commercial banks, and this was pre Great Financial Crisis and including through Great Financial Crisis. And so that was really creative and entrepreneurial because it was a brand new fund. It was somebody I had worked for. He and a couple of other partners were starting the fund, had breakfast, and he said, "Do you want to come be the first employee?" And I was like, "Absolutely," right? Like, how cool is this? I get to go jump off a cliff with a bunch of other people and build something new. That sounds interesting and creative. And so I think it was just a natural evolution to then going on my own and founding Pareto and Company, because I had found enough people that were like-minded who could be investors, and I had found enough opportunities that needed some kind of management help, where I couldn't just do it as a passive deal on the side of my life, right? Like I needed to be involved. I needed to help with M&A. I needed to bring in other, smart investors who could add value. And, ultimately that's what created Pareto. We didn't know we were independent sponsors, right? The term hadn't been coined yet, but that's sort of how we ended up in that seat. And we continue to do it because I like that interplay of the creative and the quantitative.
Yeah, so let's dive into those deals, right? I mean, what were the first couple deals you found? How did you fund them? How did you find them?
Yep.
And kind of how did they pan out?
Sure. So, like I said, Pareto & Company has been around since 2016. We have done a total of 5 platforms over that period. The platforms themselves have included a total of about 35 acquisitions as we've built these platforms. And so, all of them have been a proprietary sourcing methodology in terms of calling somebody who calls somebody who gets me to somebody, right? And so I guess, there's other ways to do it, of course. I'm sure other guests on your program may tell other stories, but for me, it's always been, again, following that curiosity path and saying, well, who do you know, or how do I get to somebody, and what do you know about this industry that's interesting? And so, of the 5, like I said, our first deal was a fintech business. We found that through, again, I was sitting at a conference with the CEO, like literally next to each other in a room, and just started talking and kind of escalated from there. That deal we funded entirely through individual high net worth investors. So that was, our first foray, where we went out and, people in my network that I knew. One had been an accountant that I knew. I had worked for one of them once upon a time. One of them was also in wealth management, so it was kind of in my circle from UBS. Things like that, right? People I had just gotten to know. So that was kind of classic pass the hat investing. Mm-hmm. Our second and third opportunities came through sort of my broader network. So one was actually another independent sponsor in Chicago, again, in the early days of when we both didn't know we were independent sponsors. But in that deal, they were bringing a chunk of the equity. We were really technically the co-investor, right? So we brought a bunch of equity, again, through my individual investor network, and a couple of family offices were in there as well. And so we capitalized that through, both of our respective networks. Plus then we partnered with Capitala. They're a fund out of Charlotte and Atlanta. They have a number of both debt and equity solutions. They were the debt and a little bit of equity in that deal. So that allowed us to get that deal done.
And what was that deal? And then how big are these checks that you're basically putting together?
Good question. So
kind of gauge.
Yeah. So that one was a compounding pharmacy business. Our equity contribution to that one was about $4.5 million, $5 million. Similar from the other sponsor, theirs was slightly larger, but roughly comparable sizing there. And then Capitala on the debt side, they were bringing, ultimately the debt in that business grew to something more like 50, 60 million out of the gate, and then kind of expanded beyond that. So, size wise, we're generally targeting platforms in the 3 to 7 million of EBITDA range. Obviously, revenues vary based on the industry, but we're kind of targeting that size for out of the gate. And so, those were smaller deals, those first couple. Our fintech business, our initial investment was a couple $100,000. So, we'll go as small as something like that. More recently, I'm sure, like many folks you've talked to, we see the market kind of expanding and moving up market, right? So as we've looked at deals, we have had to kind of go up with it, right? Ultimately, if we're delivering something to a capital provider, they want to have something that fits their metrics. And so our best deal to date, we had an HVAC business, a residential service maintenance HVAC business. We did that deal with two groups. So Capital, again, they've been a great partner to us. They liked us enough, right, to want to do something again with us. And then they brought in a fund called Summit Park. They're based in Charlotte. And so that deal had three names on the cap table. Summit Park was the lead equity. Capital had a little slice. Pareto had a little slice. And that one was out of the gate about $30 million of equity. And we had a debt facility in waiting, basically, to do the add-on acquisitions of about another 30 million. And so, that's where you can see that the scale got bigger kind of as we went.
So
what year was that? Sorry. And then
the HVAC deal. Yeah. So we closed the platform acquisition in January of 2021. And we then did 6 add-ons for that platform, and then sold it last March 31st.
Timed it perfectly on that.
So I was curious on that 30 million in equity. So, are you just buying? Were you buying that business all cash, all equity, and there was no debt at the beginning?
So on that one, yes, because we knew for the HVAC deal, we were very sure that we wanted to do a buy and build, add-on consolidation strategy. We knew, obviously, by that point, the HVAC market was getting hotter, I guess you could say. I mean, it wasn't the total insanity that it got to, but like it was in the early days of the expansion of multiples and the focus on that. So, we knew we needed some capacity to go do subsequent add-ons. And so that one, yes, we did, basically 100% equity day one. There was a rollover component. So the platform that we bought had a situation where the original owner-founder had owned it for 40 years, built a great business. It was 33 million in revenue and like 4 of EBITDA when we bought it. And 5 years before we acquired it, he had brought on a new CEO who had literally done everything in the company. He had started as an intern in college and been a technician. And then he was like a manager of one branch location. And then he was regional, right? Like he had worked his way up. Smart guy, young guy. I think he was 50, 51 when we bought the company. And he had these great ideas about how to expand. He knew a business the next state over that he wanted to buy that was a friend of his, right? And he wanted to build a second training center for the technicians. And he had all these great ideas. And the original owner was at a point in his life and career, right, where he was saying, well, I don't necessarily want to spend a ton of my money to do all these things. The business is doing great, right? It's throwing off cash. I'm the 90% owner of the business. I'm getting all this cash. And so us buying it enabled that young CEO to sort of execute on his vision, right? We and Summit Park and Capital got behind this guy and said, yes, we should totally do that. Let's go. And, again, from a collaborative standpoint, the original owner rolled over about 25% of his equity and stayed on the board and ended up getting a check that was almost double the size of his first check when we sold it. So
nice.
Worked out great for him, and we still benefited from his knowledge, right? He had been in the industry for 40 years. He knew stuff. It's just that, he needed to be more of an advisory role, not a day-to-day, and we needed to enable the day-to-day guy to go do what he wanted to do.
So I was kind of curious, is that the strategy within the firm? Because, everybody kind of does this a little bit differently, and then I want to kind of touch on, the next phase of what you see in independent sponsors and searchers and all that other stuff. But before that, kind of diving into this specific acquisition or you guys' buying thesis, is it always to maybe buy out the original owner founder and then make sure that somebody internally is there? Or do you guys ever, recruit externally and then put these people in, you taking them off the bench and put them in a CEO? Like, what usually are you guys looking for? Because we've seen it done 1,000 different ways. And I'm curious which one has been more successful and what do you guys do?
And on that same vein too, how did this deal come about, right? Like, someone had to put it together, right? We're going to find it, how'd you identify that it had the existing operator, et cetera?
What are you talking about? It fell from the sky. I was just waiting for the phone to ring, right?
They're always so easy. You just pick up the phone. You're like, hey, you want to sell? Yeah, I want to sell.
I want to sell right now, and I'm not going to negotiate at all. I'm just going to sign the paper, right?
There you go.
No, look, it was – so maybe I'll answer the second question first and say, so how did we get to this deal? We had been thinking about what our next thesis was going to be since about, late 2019 into 2020. We had just closed on the first couple acquisitions for our dental laboratory business. We had a dental lab business. And so we were at a point in that growth of that business where, I wasn't doing the day-to-day M&A hunting as much. And so myself and my partner, I have a partner in LA, I'm here in Chicago, we were starting to brainstorm about what's the next step. And we had heard from some folks here in Chicago about, hey, some M&A is happening in HVAC. There's a couple of funds here in town that we knew had some exits. So, I was able to get to a couple people I knew who could give me some feedback of like, yeah, there's something here. And for me, it's always, I don't want to be a lemming, but if other big funds are spending lots of money, more money than I have, and throwing more people at the deal than I have to pursue an industry, that's interesting to me, right? And I want to know why. And so we just started calling a ton of HVAC companies and trying to get to owners that wanted to talk to us. And I started reaching out to like investment bankers, business brokers, right? Other kinds of intermediaries in the space just to say, who should we talk to? What's going on? And so we ended up getting to a kind of boutique bank that only did HVAC. And
interesting.
They weren't running a process for this deal, but they were like, hey, there was this company that we had sort of been working with, but like, they're not really, in the middle of trying to sell, but they certainly think they might want to sell. Like, do you want to talk to them? So it was more of a referral than a process, right? It was more, hey, that they knew them, they put us in touch, and then really we just started talking with these owners. And the more we heard about what they wanted, I recognized, as I said before, that they had kind of different visions, right? Like the older owner was like, I want a lot of money, and the younger guy was like, yeah. And the younger guy was like, I'm not done yet, right? I'm young and I only have, I think he had like 2% of the equity at that point, right? And he's like, I don't, to me, this isn't going to change my life if I sell and get a few dollars. I need to grow this thing bigger. That's what's interesting to me. And I've been doing this a long time and I have some ideas. And so to answer your first question, yes, I mean, our strategy is almost always, can we build around somebody that knows what they're doing? I'm self-aware enough to know I do not know everything. I'm the first to admit that, especially like something like HVAC. I mean, if I tried to fix that air conditioner, it would break more, right? There'd be Freon spraying around and all sorts of problems, right? So, I'm not trying to be the CEO. That's the big distinction, right, between a search fund and an independent sponsor. I want to be the coach of the CEO. I want to be the helper of the CEO. And so for us, it doesn't always have to be the CEO, right? We've done some deals where there's other management that can stay and we can build around, or we can kind of reshuffle what seat people are in. And so it's not that we're opposed to bringing in outside experts if they can be additive to the core management team. But I don't want to buy something where the owner throws the keys at me and says, good luck.
Yeah.
Right. Like I want to make sure that like there's some institutional knowledge at a very senior level that is going to stay and be part of that growth vision. And it sometimes can be like we did with this owner for the HVAC business, he stayed on the board over the whole hold period. Right. And so he was always in the room. Yeah. He wasn't the day to day, but if we had a question about, hey, what happened 20 years ago with this client, he could answer the question. Right. And that we didn't lose that knowledge.
Yeah, in question, what did you structure for that CEO that was there, right? The person that had 2% to start with, like what was the structure and the incentive that you put in place to kind of, hey, let's go home run this thing?
So, it definitely was a conversation where we said, look, we're not going to just like give you randomly a chunk of equity, pick some arbitrary number and say, here you go. It was like, we'll maintain your your current salary. We'll give you some bonus, in line with, some hurdles that we all agree on are achievable. And then, in that original LOI, the original documentation, we had, a couple hurdles, like, if you get it to 1.5 times, then you get an extra 2%. Then it might have been, if you get to 2x, you get 3%, right? We had some hurdles where we're like, we're going to give you some additional equity that vests based on your essentially helping us hit our internal metrics. And so, I think that incentivized him the right way, because it was like, good, if I can help you aim for something, I'm getting essentially a free chunk of extra. But also, then it kind of mirrored like my incentives, because my deal with like the larger fund was, my carry was not just like a blanket, here's your amount. It was hurdle with the lead equity where, if they hit X MOIC, then, then I get a smaller carry if I get more, right? So we were trying to make sure that everybody was kind of aligned around the same goal of like, let's grow this and let's kind of win together. And so, that really seemed to play for him, because then he knew that it wasn't like the big bad private equity guys telling him what to do. It was like, no, we're actually going to go build this thing together, and it'll hopefully be a better outcome.
So I was kind of curious. I mean, we've already touched on, I think, 3 different industries that you're in. Tell the audience, tell the listeners, like, outside it's fractured, right? Which can, what does that mean? What are you looking for in these industries? That seem, like you said, you did some research on HVAC. What really drew you to that?
So I think a lot of it is, it is fragmented, right? Are there a lot of small ones we can buy? Are there, a lot of older owners that don't have a plan, and we can be part of that plan? I think it's also, is there a product or a service that is being delivered that isn't like volatile for no reason, right? I mean, you're never going to find an industry where it's like, oh yeah, every year is the same growth, right? And it never changes, right? There's no impact from the economy or whatever. But like, we don't do like consumer, for example, right? Where it's like, hey, this sweatshirt is hot today and it's not tomorrow, and has nothing to do with the economy, right? It's just consumer sentiment has changed. There are some great sponsors, some I know, who are awesome at consumer, and I applaud them. I'm like, I don't understand that, right? Because humans don't behave the way the spreadsheet says, right? They don't want to.
Speculation versus investing, right?
Right. And so for us, it's like, is there something that's being delivered that we see some kind of like core amount of demand that's always going to be there? And then where we can be helpful in areas that we have been able to help before, like M&A, right? I've closed a lot of deals. I've helped source a lot of deals. So if we see an opportunity to do some M&A, and it doesn't have to be 100 extra deals per deal, right? Even if it's just 2 add-ons to get to where we think the right size is, that's great, right? I know I can add value doing that. Another area would be sales. We've often helped the companies we invest in clarify their sales strategy or hire the right people. A lot of times it's, you don't have enough sales team, or you have the wrong sales team, or some combination of that, right? So trying to help think about sales as a function, because especially as you get smaller in the lower middle market, sometimes it's just like they don't really think about it. Not that they don't do sales, but it's
the owner himself or herself that are doing a lot of their sales too, right?
We call it the backbone: sales, marketing, HR, IT, accounting, and legal. Those are the 6 things most businesses don't really focus on. It's kind of an afterthought, and it's a way to add some immediate value, right, to the right size business where they can kind of get matured in those areas, and that is a way to really start to grow those businesses. So.
Yeah, 100%.
It kind of shifting, right? I know that obviously you're a professor, right? Adjunct at and I wanted to understand what is, talking with some of the newer students kind of coming out, like, we all talk about like the good old days and it wasn't as saturated, and searchers and all this stuff has become like this almost like buzzword. Where do you see the next 5 years going? Right? Do you feel like it's just going to, like, the bigger guys are just going to continue to cram further and further down? and make it harder and harder for people starting off? What evolutions are you seeing in this space? Because I think a lot of our listeners are going to be people that are looking for their first deal, or maybe they're looking for their second. And so they're going to be on that kind of, smaller size. And I think the competition is becoming more and more fierce, especially when you're talking about that $3 to $7 million EBITDA range. So what are you seeing and what are you hearing?
So it's a great question, because I think you're right. There is an increasing amount of splintering among the private capital world and how you can get deals done, right? There are family offices that are doing deals directly themselves. Yep. There are me and the other independent sponsors, now called independent sponsors, doing deals the way we do them. There's the search funds. And of course, there's all the traditional private equity and venture capital funds, right? So you have sort of, 4 archetypes, let's say, that exist in the space. And actually, really, if we want to try to give them names from my theater world, right, I think I called the PE and VC funds the Broadway headliners, right? So maybe we can think of the independent sponsors as the strategic hustlers, the folks that are kind of putting it all together, working harder to try to get it done. Yep. Maybe the family offices are the patrons, the passionate patrons, right? The folks that have the money, that love the space, that just want to get a cool show done. And then the search funds I'd put in the category of like overnight success, right? Which they never are, right? Overnight is actually usually like a 10-year haul to get to that point, but like they come out of nowhere and it looks like magic. And even you mentioned Hamilton earlier, right? Like Lin-Manuel's first show, In the Heights, was one of those where it seemed like it came out of nowhere, but he had started that show in college. I mean, it had like a 10, 15-year gestation going through many revisions to get to being an overnight success, right? And so, I think, to your question about the splintering and the increased competition, you're definitely seeing it. So even in the last 2 or 3 years, the number of conferences serving the searcher market and the independent sponsor market is off the charts. I mean, I've been to 9 in the last 2 years that didn't even exist. And so I'm in a room with a ton of people who are looking to close their first deal and are talking to capital partners. And so, certainly I was them once. I hope they're successful. I want everybody to be successful. Naturally, the flip side, right, is if there's more people trying to do it, some people probably won't be able to get a deal closed. And so there probably will be a natural kind of constricting of the market that I think probably will occur. Is it a cliff? Is it immediate? No, probably not, right? I don't know what the sort of trajectory looks like, but like just from a supply and demand standpoint, right, I think you're going to see like a shrinking of the people that are trying to do it this way. And that's where I think there's going to start to be more kind of interesting cross-pollination where, okay, you're a searcher, but like maybe you don't know this industry, so you partner up with a family office who the founders of the family office came out of that industry. And so, yeah, it's sort of a search fund, but maybe the family office is more involved than they would be in a normal kind of pure play search fund. Yep. Okay. At the end of the day, get the deal done, right? Buy the company, grow it. Who cares if it follows the official rules of how you're supposed to do a deal, right? I mean, especially independent sponsor, it's like my view is always, let's just get the deal done. And I always start every deal with a blank sheet of paper to say, like, what does this business need? And then I can go partner with my capital partners, however that needs to look. And, sometimes I'm everything. Our dental lab business, like I was the chair of the board. One of my other investors was the interim CFO. Like one of the other investors helped with the sales team in the early days. Like we were very hands-on. I was talking to the CEO every Friday. So we looked much more like a typical buyout shop for that deal. Our HVAC deal, which arguably was our best exit ever, Summit Park, who I mentioned, they had domain knowledge in the industry that I didn't have. Gotcha. They had done other home services deals. And so they were like, we should probably be the lead. And I'm like, yeah, you should, more. Right. And so, they kind of filled in some of those gaps that normally I would have done. And I was more focused on M&A. There was a small working group, me and a couple other people. We were, doing the underwriting, looking at the add-ons, trying to grow the business that way. And it worked great, right? Like it was a very different model. The share of the management fee and all those things was very different in one versus the other. But like at the end of the day, we got the deal done and we grew a great business and we sold it. So I can't say that that was a wrong approach, right? I think it's sometimes we all get a little bit like in our heads about, well, this is the best way and this is the most economically
the only way, right?
Right. Yeah. Like, and so I think
Oh,
it's more about just go find ways to work together and do good.
That's
do
what
good
makes
deals.
the space fun, right? I mean, the commercial real estate side, it's very one size fits all. Like there's not a lot of structures. Lenders don't let you get flexible. Equity doesn't really let you get flexible. Versus in this space, it's about, hey, let's go structure something that's a win-win. And, and we tell people don't get greedy. Don't let a deal die over 5%, right? If it's a good deal, it's a good deal. And there's upside. And so it's about getting the deal done, making sure everybody's getting kind of a win structure. But you can get really flexible in a lot of different ways, right? Even if you add in just sellers getting flexible too, right? From the role to their seller financing to earnouts, all these things are ways to make a deal work in different scenarios, right? To make certain people satisfied in certain, areas of what they're trying to accomplish. So.
And I think, one thing that I wanted to kind of just drive home for our listeners from this episode is really that misconception that you have to do all the things, right? You have to be the CEO, the CFO, and that's really what that's really the difference between searchers and the independent sponsor model, right? The independent sponsor might take less of the equity ownership of it. They might not be in the day-to-day. They might just sit on the board. They're sort of strategic advisors. So I want people to really understand those differences because it really is going to determine which direction you go in this business, right? Do you want to buy a company and then sit in that CEO role, like you said, for the next 10 years potentially and run the whole thing A to Z? Or do you want to help enable and grow an internal or external CEO and then be their advisor? I think that's the major distinction that, we do the same thing on the commercial real estate space, right? People run those properties on our behalf, right? So it's the same thing here in the M&A space where you have good, competent, knowledgeable people in that space. Maybe they're internal, maybe they're external, doesn't really matter, but you're there helping advise them and oversee those things versus doing the day-to-day. And that's such a big thing that I want people to hear from this episode that it's important, right?
And I'll reinforce that because, I don't really want to be the CEO, right? I know that's like the cool thing and you get to be on the cover of Inc. or Entrepreneur, right? And that's awesome. And I applaud people that are good at that. But like, I am much better at the structuring, the finding, the buying, the thinking through, the asking hard questions. And so I'm happy / preferring of having someone else do that CEO role. But, you have to kind of come to that term with yourself. And Some people are probably listening to this trying to say, like, I want to buy this company. I don't know what I want to do. And for some of them, they should be the CEO, right? Like if you have been in this industry for 5 years, you know everything, you know how to run these companies, you got contacts in the industry, you got, clients you could go to. Yeah, you probably should be the CEO, right? Like you're the right one to do that. More power to you. That's just going to be a very different experience than what I'm doing. And, I can have a couple of different portfolio companies at once. I can be managing different pieces for different ones, right? I can, I got to juggle that time carefully and not, have it be too much, but like that's possible. If you're a searcher, like you can only really do the one, and I mean, maybe you have a little side gig or whatever, you own some real estate or, something else, but like I've had a couple of conversations actually interestingly recently where, somebody has reached out to me, saw me on LinkedIn or whatever and said like, hey, I'm particularly in HVAC, right? They saw that we had this exit. People have reached out and said, oh, like, can you be on the board? Like, I want to do this. And a lot of what I talked to them about on that first interaction is like, well, are you trying to buy it and grow it? Or do you want to go run it? Right. And a lot of them are like, I don't know. And I'm like, well, figure that out first and then come talk to me because I can probably help you. But like, if you just want to go run it, like I'm actually probably less useful for you. Right? Because you're going to use a different kind of financing. If it's going to be all you might get an SBA loan and put in some of your money and maybe get a couple friends and family and get it done and then just go run it. And that's awesome. But I'm not like going to be as helpful to you. Right. But if you want somebody who's done it from a private equity standpoint, independent sponsor standpoint, okay, now I can maybe sit on a board or ask you questions or whatever. And so, I think that's one of those that you're spot on that like you have to decide which one you want to do, and both are great, but they're very different.
Yeah, there's not a right or wrong. So awesome.
Love it.
So with that said, I think we'll go ahead and move on to our rocket round where we ask our guests the same 3 questions. So first question, Cory, you ready? What do you like to do in your free time?
In my free time, I have a 10-year-old. And so he takes a lot of my free time. I'm currently reading him The Hobbit because I'm trying to get him to be a geek like me. And we've already done Star Wars. I don't know if you can see behind me. I have both an AT-AT and a Star Destroyer. So, we've already convinced him about Star Wars, and my wife has read him Harry Potter. So we've convinced him of Harry Potter, but now I'm working on The Lord of the Rings. So he takes up a lot of my time, but I still do theater when I can as well.
I thought you were going to tell me underwriting deals. Wrong answer, Cory.
Love it. All right. So next question here, Cory. What is the most memorable moment in your business journey?
So I think, honestly, it was the closing of the very first deal as an independent sponsor, right? Like, I started the firm. I convinced a couple of individual investors to underwrite Pareto as a firm, right? So I had a couple of early partners, almost like a search fund, right? Like they were investing in the idea of Pareto as an entity. And so that was a different conversation because it was like, they were already in my network. They wanted to invest in our future deals. And so we were all pooling our resources to go build it. But then it was like, I don't know if we're going to actually find any deals, right? I think we can. I think they're out there. I don't actually know. And so it was like the day that we closed on that fintech business, that was our first deal. And the day that we actually closed the deal, and like I was sitting there nervously watching the bank account hitting refresh to make sure that their wires came in,
And then the closings are really lackluster to begin with.
and it's so like kind of a misnomer that it's this big exciting thing where you have a dinner and all this stuff. It's like, no, there's like one phone call, like, did you get the paper? Yeah, okay, you're closed. Great.
Yeah, it's done.
But I think that was maybe small in terms of impact and what I actually did that day, but it was like, hey, it proved that the idea worked, and then I think everything else kind of grew from that.
Love it.
Awesome.
Love it.
And then last question, favorite tool or resource?
All right, so I think I'm going to break the trend of saying AI, and I'm going to say the phone and the library, old school analog tools, right? Because
what's a library, man? You got Cory, tell us what is this thing?
I mean, I really do. Like when I'm researching a new industry, I'll go try to like check out a book and like read stuff about the industry, just because I want to sort of see what the casual observer in the industry might see. And so, I feel like if you go through GPT or whatever, you're going to get a very focused, specific answer. And so I'm always trying to, read more, maybe not always a book, but maybe a trade magazine or, something where you're just kind of getting an overview, like the industry is washing over you and you're just kind of seeing like, how are people thinking about it? And I'm, I guess old enough, you can see the gray hair, like I like the touchy-feely analog version of that. And same with the phone, right? Like I told you before, all of our deals have been proprietarily sourced. And the only way to do that is to talk to somebody, right? They're not going to respond to a cold email. They're not going to respond to a physical mailer, or at least not
Especially
usually.
The age group that we're all targeting, right? It's usually baby boomers. I mean, same thing. We call it going belly to belly. Right? Like you're out there meeting them face to face. We're usually one of the few guys that actually just show up and, try to consummate a deal.
Right. And usually when you call them, a lot of times that first call, I'm like, have you ever thought about selling your business or some version of that question? And they're like, well, yeah, but I don't have any time. Right. Like, and so, it's like, it's probably something they've thought of, but they've been so busy running the business. They haven't thought about like, what does legacy mean? How do I get there? My kids don't want it. All of those kinds of things.
Yeah. Awesome. Perfect.
Love that.
All right, Cory. Well, awesome. Lots of information. We look forward to seeing you in Chicago at our conference coming up in about a month. And so, Cory, how can the listeners get a hold of you?
So definitely go to our website, which is paretoandcompany.com, and you'll see more info about me. You'll get to meet my partner in LA. You can click on various links there, or feel free to email me. So it's just Cory, Cory, at paretoandcompany.com. Like I said earlier, I like meeting and interacting with folks in the industry, searchers, independent sponsors. I want to try to bring people together because otherwise it's a lonely game, and it's more fun if we can all hang out and, have a coffee or a drink or something.
I completely agree. We'll put that in the show notes for the listeners. Cory, thank you very much.
Yeah, thanks, Cory. Really, really appreciated it.
All right. Thanks for the time.
Thank you.
Thank you for listening to the M&A Launchpad podcast. If you've enjoyed today's podcast and would like to support us, please leave us a rating and a review after you listen. I'm Casey Minshew, and I look forward to talking with you next week.